Welcome to the Finance Port, where we bring you the latest news and analysis on the global economy and much more. In this video, we're exploring the reasons behind the stock market's recent volatility and why experts are predicting a crash. Today, we're going to talk about a topic that has been making headlines recently, and that is the stock market, which has been on a wild ride lately. More specifically, we're going to discuss why some experts believe that the stock market is about to crash. So, buckle up and get ready to learn more. Let's dive deeper into each of the factors that could potentially impact the stock market. So, why the stock market is about to crash? The first factor is economic disruption due to the pandemic. The COVID-19 pandemic has caused widespread economic disruption, with many businesses forced to shut down or operate at reduced capacity, and also many companies are struggling to adapt to the new normal. This has led to lower revenues and earnings for companies, which can have a negative impact on their stock prices. The pandemic has also resulted in supply chain disruptions and labor shortages, which can affect a company's ability to produce and sell its products or services. The uncertainty about the future of the economy can also lead to investors selling their shares, causing further declines in the market. Another important factor to consider is hot inflation. Hot inflation occurs when the cost of goods and services increases at an alarming rate, making them more expensive for consumers. This can lead to a decrease in consumer spending, and as a result, companies may experience lower revenues and earnings. Inflation can be caused by factors such as increased demand, supply chain disruptions, and government policies. Inflation can also lead to higher interest rates, which we will be discussing in the next point. It can increase borrowing costs for companies and reduce investment and growth. This can lead to lower stock prices. Interest rates are a critical component of the economy. When interest rates rise, it becomes more expensive for companies to borrow money to fund their operations and investments. This can reduce their profitability and growth prospects, leading to lower stock prices. Higher interest rates can also make bonds and other fixed income investments more attractive, drawing investors away from stocks. The fallout from recent bank collapses like the Silvergate Bank, Silicon Valley Bank, and Signature Bank can seem both alarming and distant. Also, the recent news of a 166-year-old bank, Credit Suisse, being sold to the largest bank in Europe, that is UBS, and the dropping of shares of Deutsche Bank has dropped the investors' sentiments in the market. Bank failure is a significant risk for the economy and the stock market. Banks play a crucial role in the economy by providing credit and liquidity to businesses and consumers. If banks begin to fail due to factors such as bad loans or insufficient capital, it can have a ripple effect throughout the economy and financial markets. This could slow down economic growth, as companies may not have the necessary funds to invest in growth. Additionally, bank failures could cause a decrease in investor confidence, which could lead to a massive drop in the stock market. Current conflicts like the ongoing war in Ukraine and trade disputes with China have caused a major energy crisis and financial instability in markets worldwide. Geopolitical tensions can have a significant impact on the stock market. Tensions between countries can cause disruptions in global trade, which can impact the revenues and earnings of companies that rely on international markets. These events can cause uncertainty about the future of the economy and can lead to political instability, which could cause a decrease in investor confidence, leading to a drop in the stock market. The stock market is a reflection of the broader economy, and right now, there are a lot of challenges facing businesses and consumers alike. All of these factors can contribute to a potential stock market crash. They can erode investor confidence, decrease the profitability of companies, and lead to a sell-off in the market. It's essential to be aware of these risks and take steps to protect your portfolios. So what can investors do to protect themselves in this environment? Firstly, don't panic. A stock market crash is a natural part of the market cycle and presents opportunities for long-term investors. Assess your investment portfolio to determine how much you've lost and how much of it is a long-term investment. If you have long-term investments, don't sell them. They will eventually recover. Avoid making emotional decisions such as selling your stocks during a stock market crash. Instead, focus on your long-term investment goals and continue to invest in quality stocks. It's important to diversify your portfolio so that you're not too heavily invested in any one company or sector. You should also consider investing in alternative assets, such as gold or real estate, which tend to hold their value better during market downturns. And of course, always consult with a financial advisor before making any major investment decisions. So there you have it. the top reasons why the stock market can crash, and what you can do to protect yourself. Remember, a stock market crash can be a challenging time for investors, but by preparing yourself, keeping a long-term perspective, and staying focused on your investment goals, you can navigate through it successfully. What do you think? Let us know in the comments below. That's all for today's video. We hope you found this information helpful. Don't forget to like and subscribe to our channel for more finance-related content.